Welcome to the April 2023 monthly MOTR Checkup. My name is Dave Lundgren, and I'm the Chief Market Strategist and Portfolio Manager here at MOTR Capital Management and Research. Just a quick look at the disclosures for you here before we get started. The title of this month's video is "Banks Must Stabilize Before the Bulls Can Run," and I think the main thing to take away here is that it's incredible how resilient the market has been with all of the things that have happened over the past really 9 months, but particularly in the past month. But the reality is the market is also has not moved higher. So it's been resilient. That's undeniably true. But there still are a lot of things that must be churned through before and corrected before we can anticipate that the market can put together a sustained run higher. And I think most importantly, that will be that the bank sector needs to stabilize and stop going down. And as I'll show you, that has not happened as of yet. At the end of the day, what it strikes me is that despite all these headlines, given how well the market's behaved, I'd said this earlier before Silicon Valley broke down, but nonetheless, it looked to me like the market was anticipating better times ahead for the market and for of course for the economy than what was largely anticipated by investors, broadly speaking. And I still think that's the case. And if anything, I might even say it's more so the case given the heavy load of negative headlines that had been thrown at the market, and yet it still has held 3,800. So I still think that the market is looking forward to better times ahead. I just believe that this most recent crisis has probably delayed the good times for a bit, but nonetheless, I think they're coming. So the main thing once again is that banks need to stabilize. They don't need to lead the bull market higher. We've seen a very strong bull market since 2009, with banks underperforming since 2006. So it's clear that banks don't need to outperform during a bull market, but they just can't be going straight down. And so until we see the stability that's required within the banking sector, then it's just makes sense to anticipate that the market will continue to go sideways until such time. It's interesting to point out, and we'll cover some charts on this, but since Silicon Valley collapsed on the 7th, there's been a tremendous amount of relative strength in gold and crypto. So nothing from a trend change perspective that's been significant, although I guess you could say more so in crypto than gold. So in other words, the trends aren't yet clearly to the upside, but certainly have improved quite a bit since Silicon Valley collapsed. So let's take a look at some charts just to kind of center ourselves on what's been going on. This is a chart that most of our research subscribers have probably grown painfully accustomed to, because I've been showing this, basically a version of this chart since November, detailing these support and resistance areas. So the way I think about these bear markets is that a crisis bear market is one that follows a traditional cyclical bear market. So a traditional cyclical bear will get the market down 20 to 25%. The only way it goes further from there is if we have an actual crisis that takes it down another 15 to 20%. The alternative to that is that you go through this cyclical bear market, and then the market stabilizes and then begins to look forward to improvement down the road and begins to stabilize and then ultimately move higher into a new bull market. And so we're kind of faced with, which one are we facing right now? Which we have to kind of decide which one are we facing? Do we have another crisis coming and another 15 to 20% to the downside, which I think there's a number of strategists out there that are arguing for that? Or have we seen the worst of it and we're now just going through this stabilization process before the market ultimately moves higher? And the only thing I can say is that, at the end of the day, this past 6 months, we've had pretty much everything thrown at this market, including the second largest bank failure in U.S. history, and we still haven't broken 3,800. So to me, I'm leaning in the direction that this is a cyclical bear market that's that's more driven by economic slowdowns and earnings recessions and just traditional run-of-the-mill type stuff, and not a crisis bear market, which means the lows are in, and then it's just a matter of when does the cyclical bear market end and when do we transition to a bull market. And at this point in time, as the evidence will show, and as I've been following all along in my notes, it's the backdrop is constructive, but it's just not quite ready for prime time. So another chart that I've featured in recent notes is this idea that the market since May has really been oscillating around this central tendency of around 39.50. So again, despite all of the bad news that's come out really since May, we've really just been range bound, and you've got this sort of plus 10% and minus 10% band that formed, and then from the August peak to the October bottom, we then started to see this constriction in the volatility around that 39.50 area, indicating that we sort of have this coiled spring. And so what I continue to think is pretty constructive is the fact that we've gone through this cyclical bear market. We've had a crisis. We have the setup for a crisis with the banking failure, and despite that, the 50-day average has not only held above the 200-day average, but it's actually continued to rise throughout this most recent banking crisis. So much so that the 200-day average itself has begun to rise. So this looks to me like it's taking on the certainly a coil, but a coil to go higher in time. And so then it's just a matter of when do the ducks align, and when do we see the evidence to suggest that we're ready to go higher. We don't see it yet, but ultimately that is what we see down the road. So we know with the banks as poorly configured as they are, we don't want to be complacent. I think it's worth continuing to have some short exposure on it, particularly within the banking industry. But by and large, I think it's just tactical maneuvering before we move higher ultimately. So I showed this diagram last month in last month's video, so I think I just want to repeat it again just to restate where I think we are. So we have this 5-wave process that typically demonstrates or details or sort of follows along the roadmap from bear market to bull market. In the first phase of this transition from bear to bull is this number one, which is basically that explosive move off the bottom. This is that momentum crash in short covering, and I think that's what happened from October to December. And then the second phase is this prolonged, frustrating period of congestion and sideways movement that can take months, if not many months. And it's just about the market stabilizing after a bear market, trying to settle down and figure out what the future leadership is for the next bull market. And I think this is the phase we're in. I think the fact that we were able to go through this bank failure without taking out 3,800 just in my mind really corroborates this idea. And so and then from here, of course, we have phase 3 takes place, the new bull market. Obviously we're not there yet, but the point is that once the bull market gets going, be mindful that the headlines will likely be still be quite negative. It might even entail more bankruptcies, but nonetheless, along the way, the corrections that unfold as a result of that negative news are likely to be less durable and less prolonged than what we see here in phase 2. So like a phase 4 correction and would likely be just a much briefer affair than what we're seeing currently in phase 2. And then of course, phase 5 is that speculative phase where, the last one we saw, of course, was 2021. That will happen again. You can rest assured. They've been happening since the beginning of speculation. So it's just a matter of getting through this phase 2 before we can look forward to that. And I think that's what we have before us. So here's a snapshot of the 6 ways to look at cyclical leadership relative to the market. And when you just look at this picture, there's just not a lot of clarity. Yes, we have tech leading most recently since the beginning of the year, but ultimately you could say that it's still just a range bound condition with the 2022 peak still looming large overhead. Industrials still look great, but you can see that they've taken quite a nosedive here on a cap weighted basis. Discretionary is just nowhere to be found on a cap weighted basis. Energy still looks okay longer term, but obviously has taken on quite a bit of water since peaking in October, November. Materials, just one big range, so not much to say there. And then, of course, financials have collapsed. So when you just look at and think about what this leadership is supposed to look like in a robust bull market, it's just not there yet. So it's not bearish. It's just more evidence that we're just not ready for prime time. The good news is when you look at this same analysis, looking at the defensive sectors, there's not a lot of strong leadership coming from the defensive sectors either. So we don't have let me just turn my spotlight on here so we don't have a lot of strong leadership coming from these defensive sectors like 2022 was strongly led by staples, strongly led by healthcare, and strongly led by utilities. So obviously that's all changed. So that's the good news. So we don't have, I guess the good news is we don't have strong leadership coming from anywhere. So with a backdrop where the market's been somewhat very resilient and resistant to some pretty negative headlines, that's the good news. The bad news is we just don't quite yet have strong, clear leadership to take the market higher yet, which again, that's very typical of phase two in a transition from bear to bull. So nothing bearish there. It's just once again showing you that the market's just not quite ready for prime time. When we do this analysis on the sectors from an equally weighted basis and just rank the sectors according to their performance, which you can see here, and you're ranking every stock within the sector and then just averaging it out, so you're not getting a cap weighted bias. It's more like a equally weighted bias. What you can see here is that other than staples, the leadership is very cyclical: industrials, discretionary, materials, energy, and technology. So that's certainly positive. This is where it kind of gets a little bit murky, but although all of the sectors on an equally weighted basis, on a average rate of change basis, they're all positive since the market bottomed after the Silicon Valley collapse. That's a positive. The reality is that only three sectors, and in the three sectors I'm referring to, are actually defensive. Only three of them are actually positive since the day before Silicon Valley broke down, and you can see them here. So yes, we're up 7.5% off the bottom since the bank failure. But when you measure from the peak prior to that bottom, only three sectors are actually positive. So again, not the kind of thing that you would expect from a market that's ready to go higher. And when you look at the financials, you can see that they're down on average 9.5% since that peak following this Silicon Valley failure. So just another way of looking at sector leadership, it tilts quite a bit more favorably than looking at the sectors cap weighted, but nonetheless, it's still a bit of a murky picture. So a little bit more time is required, and I just think that this is a message that we're seeing showing up in the data more and more as we go forward. And then, of course, the average stock is still down 3.5% since the bank failure. So again, although the S&P itself is above where it was when Silicon Valley failed, the reality is the average stock is still below. So again, much work to be done here. Although it still tilts positive, it's just not quite ready. I would also just highlight another way to look at what's happened since the Silicon Valley failure. What I'm doing here is looking at all of the sectors, and I'm just looking at all of the relative highs and relative lows that have happened since then. So what percentage of the tech sector has hit a 13-week relative high since the March 6th peak? And you can see here it's 52%. And then we do that same analysis across the various timeframes of relative performance. So 13-week relative high, 26-week relative high, 39 and 52. And then we do the same analysis: what percentage of the sector hit a 13, 26, 39, and 52-week relative low. And then we just simply take the spread, and then we rank that, and then just take the average of all of that. We end up getting this overall performance score of spreads of relative highs and lows across the various timeframes. So when you do that and you sort the table by the best to worst, what shows up on top is a pretty decent picture here. So tech and industrials are actually the number one and number two sectors in this analysis. So it's not shocking to see staples and utilities showing the most relative highs since the banking crisis began. But what is a bit surprising is to see that those two sectors are actually beat out by tech and industrials. And then when you look a little bit further down, right behind staples and utilities are discretionary materials, and they fare pretty well. So that's from a relative performance perspective since the crisis started, which again, I want to highlight crisis. What's been actually breaking out more so at the margin is cyclical, sort of offensive type sectors. So that's, again, positive at the margin. What we find at the bottom is healthcare, energy, financials, and REITs. So and REITs in particular are just abysmal. So a bit concerned about that. Financials, as bad as they are down here, again, reason to put the brakes on in terms of being too optimistic on the market here. We need to see these things stabilize in time, but the fact that what's happening at the margin is relatively robust and positive suggests that in time these things will repair. That seems to be the message of the market. So we want to just kind of go with that until we see otherwise. So this is a concept that I've touched on a couple of times, but it's happened once again. So I want to because I just really think it illuminates what's really happening beneath the surface relative to what appears to be happening at the surface, on the surface within the S&P. So over the past month, the S&P is up more than 6%. So basically, essentially since the bottom following the Silicon Valley bank failure. So the market's up about 6%. And when you look at the top contributors, this is sorted highest to basically these are the top 20 contributors, sort of from most to least most, if you will, since over the past month. 8 of the top 20 contributors to that gain are still in a long-term downtrend. 8 of them are consolidating downtrend. So you can see these arrows here. So they're all 3s, not -5s. So -3 is a consolidating downtrend on the long-term chart. So as strong as these charts have been, they're still in some form of a long-term downtrend. So that's just, if this is the leadership, that's what the leadership looks like. It contributed an awful lot off the bottom, but they're still in a downtrend. 3 of the biggest contributors are actually in clear downtrends. So they're not even in consolidations of downtrends. They're actually in clear downtrends. So that's Amazon, Johnson & Johnson, and Tesla. So just to give you a sense for what I'm talking about, I've talked about this, but I haven't really shown charts. So here's an example of a chart that's contributed substantially to the market's year-to-date gain. And this is what it looks like. So when you go through that checklist, the trend change perspective or process, you see a clear head and shoulders top here. This is Tesla. And this stock has contributed massively to the year-to-date gain of the market. And yet this is what the chart looks like. And I can show you several charts that look like this that are big contributors to the year-to-date gain for the S&P. But this is what the chart looks like that actually drove that gain. So again, it's not bearish. It's just showing you that this is where we are. This is what needs to be improved upon as we move forward, if and when we are actually going to break into a robust bull market, which again, that is my perspective, but it's just these are the reasons why we need to kind of be patient and even still at this point entertain some short exposure as we move forward. Of the 20 stocks that contributed the most to the year-to-date gain, only 4 of them are actually in clear uptrends. And interestingly enough, 2 of them are healthcare and 2 of them are from the energy space. So again, just more things to contemplate as we're trying to wrestle with this sort of sideways range with a lot of volatility that's been taking place in the market. This is a chart of the KBW regional bank ETF. And again, you can clearly see that the bank sector has been a structural underweight. It doesn't show it on this chart, but this actual relative performance downtrend actually goes back to 2006. I have shown that chart in past weekly reports and videos as well. So you should know what I'm talking about, but it's been a structural underperform since before the global financial crisis. There have been bouts of outperformance, as you can see here, but ultimately in the context of a downtrend that continues to resume. So even still, if you did play that short-term tactical bounce within the context of that ongoing downtrend, and you followed that checklist of trend change, that checklist of trend change would have had you out of banks coincident with, by the way, the beginning of the bear market that started in early 2022. So here's that trend line. That's first step of the checklist of trend change, and you break it here. Second step is to break the last swing low of the uptrend, and you see that happening here. So you've got the first two boxes checked. As in my work, that's all I pretty much need. I just need because you have the definition of a downtrend is a series of lower lows. That second step right here is a lower low. So as far as I'm concerned, this isn't a downtrend. So I'm more prone to react to that and execute and remove these positions from portfolio. But if you want to wait for further confirmation, what you'd wait for is the 50-day to cross over the 200-day, and then lastly for the 200-day to average to turn down. So by the time you get all four of these boxes checked, you should be out of banks. So we can clearly see that banks that the checklist of trend change process cleared us out of the banking sector early 2022, but at the same time, it also gave a strong warning of the impending bear market, because as I said, banks don't need to lead in a bull market. They just can't be going down. And in early 2022, we got ample reason to sell whatever bank exposure we had, but also the follow-on conclusion there was that because banks were not just a relative sell, they're an absolute sell as well. You might be in the throes of a cyclical bear market, broadly speaking, in the market, and of course that ultimately is what happened. Now it's true that it looked like we had a bit of a decent base here as the market itself was bottoming out, but there was very poor relative performance, and of course the whole Silicon Valley thing happened and just completely obliterated whatever basing structure existed there. So the point, though, is that until we can fix this chart, I think there's just risk. There's risk. As long as there's risk to the banking system, there's risk to the market, broadly speaking, and we need to see that that resolved before we can get too optimistic on the broader market. So it's just something to keep at the forefront of your mind as you're thinking about the broader market, that this chart needs to be repaired before we can get too optimistic and too aggressively positioned as we were earlier in the year. So looking at the banks, the financial sector overall, in ranking each of the industries within the financial sector, this is what it looks like. And what we can see is when you're just looking at the underlying structure of the sector in the industries within the sector, every U.S. banking industry has the majority of its constituents in a long-term quarterly downtrend. So when we look at this chart is actually showing you what percentage of the industry is in a positive trend. So we can see money center banks, only 29% are in a positive trend, and then the rest of them are down here. All the other U.S. banking industries are down here, and the majority of them are in a downtrend. Foreign banks are better, but they're still bad. They're just less bad. And then when you look at private equity and business development companies, they are in rough shape too. So we need to see this improve. As long as these trends are configured in this manner, it just strikes me is that there's a potential for there being a message of risk here, and we just need to be mindful of that and remain actively engaged with short exposure here until this picture gets better. One thing to highlight is that since the banking crisis began, and especially since the bottom in March 13th, is we've seen a tremendous pickup in relative performance from pretty much anything related to gold, the precious metal, silver, and of course anything related to blockchain, crypto, whether it's the GBTC or the stocks that are tied to these two themes, crypto and gold. So it's on the one hand, it's constructive to see a part of the market responding well, but on the other hand, the fact that it's these two particular industries could potentially be a fly in the ointment as well, because gold typically doesn't work in periods of bull market activity for the broader market. So let's just be mindful of that. So this is the chart of gold. It's basically been in a range. If you ask me, do I think that this looks like it's going to be resolving to the upside? I'd say, yeah, that looks like a range. It looks like it's going to resolve to the upside in time. I would just say that at this time, this is not the best place to put that bet on. So I think you can make the case to be long some gold names. I'm long some gold names, but as I'll show in a moment, it's just not. It's not. We're not quite there yet for a strong overweight in gold names. Something like to the equivalent of something like what we saw for energy last year. And of course, if we see something that's that strong for the gold names, as like we saw for energy last year, we also have to consider the possibility that there's something materially bad happening, because energy can lead like that, and we can have a strong bull market, but typically you don't see gold stocks leading like that. Typically when gold leads from a relative perspective, the broader market in a very strong way, unless it's exceptional circumstances, it's usually leading by going down less. So just want to be mindful of that. When you look at the industries within the material sector, this is something we've been monitoring along as well. The gold mining industry has actually overtaken the #1 spot within the materials space, followed by steel, metals, industrial metals, and steel specialty alloys. So this again is pretty cyclical. Save for the gold mining, that's still another pretty cyclical reading on relative performance. When you look at the gold names, the daily through weekly, so the monthly, weekly, and daily time frame of charts, they all look actually pretty good. But here's what I'm talking about with that longer term perspective, where you need this longer term quarterly chart to inflect as well, because that's the fundamentally driven chart, and we can see that only 38% are in an uptrend. So when you're buying gold names, the risk is that you're buying into an overbought downtrend. So the fact that you have the majority of charts that are trending positively here says that you have enough structure to manage at least a tactical trade here, so you can be long this space. Just be mindful that you're not quite in blue skies yet, because you have a lot of overhead resistance still on these quarterly charts. So just something to keep in mind as you're contemplating being exposed to the gold space. And then when you look at crypto, looking at that checklist of trend change, you can see it taking place here. Break the downtrend, break the last swing high, and then that 200-day average turns higher. You've checked the boxes for a positive swing higher here in crypto, which could be viewed as being a risk-on measure. Hard to tell if it's risk-on or if it's people that are concerned about inflation and the world falling apart buying crypto. I don't know. I don't care. What I do know is that it's that we've checked the boxes in this checklist, and so the upside from here is 40,000 to 45,000, and I think you should anticipate that we should see some pretty strong resistance in that area. So for me, it's at the margin, it's a positive to see crypto inflecting, especially when you consider, like, once again, that crypto basically bottomed almost to the day that FTX collapsed, which is the ultimate irony. So the fact that we've gone through 25,000 clears the skies to 40 to 45,000, which has the potential to be a risk-on interpretation for the broader markets. So again, something at the margins potentially positive. So just to quickly summarize here, at the margin, the conditions are very stable and resilient, considering everything that the markets had to absorb over the past several months, and certainly over the past the most recent month with the bank failures, et cetera. What my interpretation at this point, given that the market has been so resilient and able to hold 3,800 despite all of this, these potential crisis moments, is that we've just delayed what was likely to be a bullish resolution of this range that we're in, but we haven't killed it. So we just need to digest this, stabilize the bank sector a bit more before we can ultimately move higher. But that is ultimately what I think will happen. And as long as we continue to see cyclicals within the leadership, as long as we continue to see utilities and other defensive parts of the market, lingering in the bottom of the leadership competition, if you will, I think that's all indication that the market's looking forward. It likes what it sees. It's just absorbing all of the bad news and kind of settling on what leadership is the right leadership for the next bull market. So right now, as what I can see is industrials, tech, discretionary tech still are leadership. I would continue to maintain exposure there. You can have some exposure within other areas as well, of course, but this is the dominant. This is where the dominant area that I would be looking for your exposure. And until banks do stabilize, I want to have some short exposure there, as well as some other areas, even within industrials, in some areas within discretionary, and even within tech that are also showing some failures. So I want to, as long as there's some incremental potential for a crisis moment, I want to have some exposure there on the short side as well. So as frustrating as it may be, I still don't see any reason to change the primary resistance and support levels to keep an eye on for the S&P. These are levels that we've been monitoring since November, and they've held since then. So 4,100 to 4,300. I just think when you're in that area, I just don't think that's the right area to get all bulled up. And then when you get into the 38 to 3,900 area, obviously that's clearly been the place not to get all bared up. So within that range, as long as we're within that range, I just have a longer term constructive view, but a more tactical, neutral perspective, if you will, with an awareness of not getting too bullish between 41 and 4,300, and not too bearish between 38 and 3,900. So that's where we stand as of now. Thanks for listening, and as always, feel free to reach out to me through email. Reach out to myself or Rick Casella. We're happy to hop on the phone and do any calls with you, or do any portfolio reviews, or anything that you'd like with respect to your coverage or portfolio, or idea generation, or whatever. However you think we can help, get us on the phone, and happy to do that. Thanks for listening.